This is Power Trading Radio Live. Power Trading Radio Live, fueled by Online Trading Academy. For more information on the show, visit us online at powertradingradio.com. Now, here's your host, Merlin Rothfeld.
Hello, everybody. Welcome back to Power Trading Radio. It's your weekend edition. My name is Merlin Rothfeld, and of course, since it's the weekend edition, we have the ambassador of opportunity, John O'Donnell, here in studio with us. John, welcome back.
I'm glad to be back, Merlin. Do you have those boots on today?
You know, this is all TJ's fault. You shouldn't show me in patent leather boots, TJ. That just doesn't work anymore. You gotta change that down intro. All right, so it's a weekend edition, and actually I'm already getting a lot of compliments for our guest who hasn't even said a word on the show today, but he's been on in the past, and he's got a bunch of fans who are, or some of our viewers are definitely fans of your guest today. Who do you got for us, John?
Well, today we have a gentleman who's, I believe this is his third appearance on Power Trading Radio. We have Rick Rule. He's the president and CEO of Sprott U.S. Holdings. Mr. Rule has dedicated his entire life to many aspects of natural resource securities investing. In addition to the knowledge and experience gained in long and focused career, he has a worldwide network of contacts in the natural resource and financial world. Mr. Rule is also a director of Sprott Inc. The parent company is Sprott U.S. Holdings Inc. As president and CEO of Sprott U.S. Holdings, Mr. Rule leads a highly skilled team of earth scientists and financial professionals who enjoy a worldwide reputation for resource investment management. Rick, welcome to our show.
Thank you very much for having me. I enjoy the process.
I would like to think, Merlin and I would like to think that this is your victory lap kicking off the year. Gold had a wonderful 2019, up almost $300 per troy ounce. Congratulations, you and your investors must be feeling pretty good about 2019 in the natural resource space.
We feel great about 2019. You will remember that there were a few dry years ahead of it. So
Yeah, there were.
We feel like we worked 12 hard months to be overnight successes. But no,
I got it.
It was a great year.
Congratulations.
Thank you.
Give us your 30,000 view perspective of where are we today in the natural resource space, coming off a good year like that. But you're very close to the funding, to the venture funding and development of mining properties and energy properties. Give us your 30,000 foot perspective. Where are we today?
Well, the outlook is very mixed. Precious metals markets continue quite strong. There is now fairly widespread nervousness. I wouldn't call it fear or terror, but fairly widespread nervousness, particularly around the global bond market with negative yields and things like that. Mm-hmm. And precious metals generally do well when investors express fear related to the long-term purchasing power of fiat instruments, and in particular, U.S. debt. So the precious metals markets are in pretty good shape, and the rise, although it's been decent, hasn't been that sort of, hockey stick rise that causes an immediate decline. The market has gone forward which is a very healthy market. Importantly, too, the bullion has moved more dramatically than the shares have traditionally moved relative to bullion, which is to say that we aren't yet in a really enthusiastic market, which suggests that this bull market has some legs. So with regards to precious metals and precious metal stocks, the market is in really, really good shape. The outlook for other natural resources is a bit more cloudy. The industrial materials market, by that I mean things like copper and nickel and also oil and gas, are a bit constrained, although the oil price took a bit of a kick as a consequence of the hostilities with Iran. But the truth is the outlook for natural resources other than precious metals, industrial materials, the outlook is nuanced at best. We're 10 years now into a global economic recovery, depending on how you count. And I'm not trying to say, nor is the market trying to say, that a recession either in the U.S. or around the world is immediately at hand. But certainly a 10-year-old recovery is a recovery that in a historical sense is quite long a tooth. So the markets are expressing skepticism about demand levels for industrial materials and energy. As to capital availability, which is a lot of what Sprott does, the last 2 years has really brought about a sea change in the availability of capital for natural resources. We're seeing European capital that's been absent from the market for 10 years. We're seeing a continuation of capital availability from the Far East, China, Korea, and Japan in particular. But we're also seeing the U.S. generalist institution, particularly the pension funds and the university endowments, long-term investors wanting to make investments in natural resources, not merely precious metals resources. The fly in that ointment, I think, is the beginnings of a pullback of some institutional investors, and particularly sovereign wealth funds, in natural resources that have a carbon footprint. Certainly, investment demand for coal-related products is dead, although demand for coal is excellent. And there's an increasing lack of demand for investment products around the oil and gas business, although the business itself is quite healthy.
You know, when you were mentioning precious metals, obviously birds of a feather tend to flock together, and I was actually just, as you were talking, looking at platinum and palladium as well as gold, and obviously gold's the main one that most people would look at. Obviously gold's done fantastic. Platinum's done okay. Palladium, the last year or two, has just gone absolutely gangbusters. What do you attribute that to, and is this something that's sustainable for palladium? Because it's, TJ, bring up that chart here real quick. You guys, if you'll notice this one, you go back into 2018, palladium was trading at about 824. It closed at 2,072 as of today. So you're talking a 2-year period, well, a little less than 2-year period, with just monster gains, 150%.
You know, I've been a palladium bull since 2012, and this market really shocked me.
Yeah.
I hadn't anticipated anything like the shortfall in palladium that we would face this year. Of course, ongoing demand for platinum and palladium is really a function of global motor vehicle sales and of tightening emission standards in emerging and frontier markets, including prominently China.
Mm-hmm.
Although a lot of people are concerned about the impact of electric vehicles, it's worth noting that electric vehicles have less than a 2% market share worldwide in a vehicle market that's growing faster than that. So that's not an immediate concern, and probably actually not a concern for platinum and palladium markets for 20 years. It's interesting, the disparity between the market for palladium and the market for platinum.
Right.
And the causes that I see are fairly ironic. For many years, the palladium price was lower than the platinum price. And the consequence of that was that a lot of fabrication technologies took place that would favor palladium over platinum. The consequence of that is that demand for palladium, as a consequence of those fabrication technologies, expanded faster than they expanded for platinum. And it's been difficult for the industry to reverse the process, substituting platinum for palladium. But certainly with this price disparity, that will happen. Mm-hmm. As a rule of thumb, palladium is used more extensively in gasoline engines, and platinum is used more extensively in diesel engines. So demand for platinum was really sideswiped by the Volkswagen diesel emission standards. Uh-huh. And the collapse in sales of diesel vehicles around the world, but particularly, of course, in the European Union and in the United States. So we've seen a circumstance now where the utility of the materials, as expressed by price, suddenly favors platinum over palladium. Sure. But the lead cycle, the time that it takes to develop fabrication and utilization technologies, probably 5 or 6 years. So I think what you'll begin to see is palladium level off, and platinum beginning gradually in fits and starts to fill the void.
Yeah, so for the viewers at home, TJ, bring up these charts real quick, just so you understand what kind of Rick was pointing at. And this just only goes back to late 2016. You can see that platinum, while it's had a phenomenal move since, let's say, mid-2019, it's still, we could say, just chopping sideways for the better part of the last 3 years. I know it's like a $250 range, but it's still just trucking back and forth. But if you look at palladium, there obviously has been a very different looking picture. If you go same time frame back to mid 2016, palladium was down in right around $500, and now you're at 2,000. So this is one of the reasons I brought it up, Rick, is we have a lot of active traders out there who are going to look at something like this and go, is this sustainable in palladium futures? If not, maybe I'm going to look to be selling some of these, maybe go from the short side and make some money when it comes down. It just feels like it's very long in the tooth right now, but this isn't an area that I'm generally trading in. I'm more of an investor in gold and silver. But boy, when you see something that goes parabolic, like it feels like palladium is almost doing, to me, it's a very dangerous thing to try to anticipate picking a top in that one.
Yeah, the risk that you have on the short side with palladium is political constraints to supply. Both platinum and palladium are produced principally in Russia, South Africa, and Zimbabwe. So you have an opaque market, Russia, a disaster area, South Africa, and then Zimbabwe, which makes South Africa look stable. In any of those circumstances, remembering, too, that the platinum and palladium from Russia come from just two mines, the difficulties that shorts would face, were there an unexpected period of labor or political unrest in South Africa, or some problem, labor-related problems, an example in Russia, is pretty extreme. And it's made more extreme because of the economic utility of platinum and palladium. And when I mean the economic utility, it takes probably $150 worth of metal to put in place a catalytic converter that enables the sale of a $30 or $40 or $50,000 car. If the price of the material doubles, it has no near-term impact on demand, because if you had to put another $150 into a $40,000 car, it wouldn't change the sticker price of the car. So the shorts need to contend with unusual demand inelasticity relative to price, and they also have to deal with an extremely constrained supply network. So I would be extremely cautious about being on the short side. I'm not saying that you should be on the long side. I'm just saying that if things went wrong in that space for you, they would go really wrong.
Sure. And it's interesting because as someone who's done this for so long, I know that you've seen your share of strong trending markets, of either up or down, even sideways chop. And do you have a general rule for yourself, for your clients, where you say, hey, you know what? This thing is it's gone too far too fast. It's probably best to just lock in some profits and move on and wait for a pullback to buy into it? Or is there, you just keep riding it with the grander scheme in play? Because I'm one of those guys who I'm a little bit skeptical when something moves as quickly as palladium has, because it seems like such an outlier compared to some of the other metals. Of course, we know metals are extremely volatile. But I tend to be one of those ones that I jump ship a little bit early with some great gains. Are you more of the hold on to it because it's bucking real good right now?
No, if I'm given money, that is, if I think that a market's ahead of itself, I'm not a trend player. That isn't among my skill sets. I have a very rough sense of supply and demand and pricing dynamics, and to the extent that a material is substantially undervalued, I tend to be a player on the long side and also a player for the long term. But the truth is that all metals, all materials are extremely capital intensive and extremely cyclical. Mm-hmm. So when a material gets overbought, I tend to just, I tend to use what in equities would be called fundamental analysis. The metals markets are unusual because they're so capital intensive. And what that means is that when demand begins to exceed supply and the materials begin to go up in price, the supply response, the ability of the industry to match that pricing signal with increased supply, is really constrained because they're capital intensive and it takes a long time to add productive facilities. Similarly, after production has been increased and the price begins to slide, producers tend to continue to produce all the way down to and through the cash cost of production because they have so much capital tied up in productive capacity.
Right.
So bull markets and bear markets in metals tend to be much more exaggerated, much more pronounced than they are in normal financial circles.
I don't know these numbers offhand. You probably have a greater sense. Do you happen to know a ballpark of what the extraction cost for palladium would be, kind of what that baseline floor is?
It's very difficult to say because the most important palladium producer in the world is Norilsk, which is primarily a nickel and copper producer. So you need to decide whether or not you price it as a byproduct.
Right.
There are people that would say that Norilsk's cost of palladium is zero because they cover the cost from their nickel and copper and cobalt operations. Yeah. So it's very, very difficult. You can certainly look at the South African producers where their product stream might be 60% platinum and 40% palladium on a value basis, and then draw a rough cost of production. And by the way, the increase in palladium price has been an absolute lifesaver for the South African platinum and palladium industry, which was really on death's door 2 years ago.
Yeah, I bet. The only reason I ask is because, when you look at something like gold, it's easier to say, okay, well, the extraction cost of gold is X, and most people kind of know that number or ballpark it. So, you get a sense as an investor, someone long term, that, hey, you know what, this is, it's selling cheaper than the extraction cost, so therefore, over time, it's probably a good idea for me to be accumulating some of this. And I was just curious because I don't know much about palladium futures other than my catalytic converter, my Toyota, is a coveted item that some people tend to cut out. We actually had, I kid you not, we had some gangbangers in a parking lot here in Southern California cutting out catalytic converters from Toyota pickup trucks, which of course I have one. One of my colleagues, they busted the guy before they ripped it out of underneath his car. But broad daylight, just sitting there cutting out people's catalytic converters because of the palladium in it.
Yeah. Nope, that's right. That's right.
Rick, let's take a look at the gold equities. If we take a look at gold equities have generally, especially in a bull market, well, even in a bear market, the gold equity sector, like GDX or GDXJ, have typically outperformed bullion. How do you assess this in this particular trend nowadays?
What's happening now is very helpful. The principal buyers in the gold market right now are fear buyers. So they're buying for insurance purposes. Mm-hmm. The move in gold equities relative to gold is about half as strong as it has been in traditional markets. And that says that this is a market that is, although it has done well, is not experiencing any speculative excess whatsoever. And the truth is that a lot of the increase in the GDX in the gold equities has been done via merger and acquisition activity, which has been pronounced, rather than through normal market forces. So what we're seeing is a very muted, very healthy response in the gold equities. If you like, I will send you and your viewers a 40-year gold equities chart, the Barron's Gold Mining Index. I refer to the Barron's Index because it's the longest running gold equities index that I can get my hands on. And looking at that chart is extremely instructive. I'm not a technical analyst, but the picture that it paints is extraordinary. The first thing that shows you is just the unbelievable volatility in gold equities anyway. The 40-year chart makes you dizzy looking at it. But probably more importantly, when you look at that chart, you will see that right now we are approaching a bottom, at a bottom, or just off the bottom, that in a historical context is extraordinarily pronounced. There have been 9 aggressive oversold bottoms in gold in the last 40 years. And the recoveries from those oversold bottoms, I'm not talking about for individual stocks, but for the entire index, has been between 175% and 1,000%. And those recoveries have taken place over periods of time as short as 2 years and as long as 4 years. And it paints a very, very healthy picture of where we are. It's very instructive. I'm not saying that gold is going to that the gold stocks are going to take off tomorrow and go to the moon. But if you look at this chart and you look at the valuations of the companies in a historic context, you will see that we are fairly close to a bottom, and that the upside potential, at least the upside potential indicated by the charts, relative to the downside is extraordinary.
So that being said, that premium being minimal versus the historical trend, you would lean in the favor of buying GDX versus gold bullion in a particular portfolio if you were looking for more beta on the upside. Is that correct?
Yeah, I think it depends on who you are. I personally buy bullion not for capital gains, but rather as insurance.
I got it.
I regard it as extraordinarily good liquidity. A financial planner would tell me I'm stupid to buy gold because I'm the largest shareholder of Sprott, which is in effect a brand name for gold investing. But the truth is I'm old and fat and rich, and having liquidity allows me to sleep nights and stay calm. I'm not owning gold myself because I think or hope the price is going to go up, although I'm guilty of both of those. I buy gold equities for that reason. I buy gold equities for market beta. And as I say, for people who aren't buying gold out of fear reasons, for people who are buying it for portfolio diversification, or simply because they see a circumstance coming up where there will be more buyers than sellers, certainly one should be in the equities rather than the bullion.
Rick, I didn't realize we had so much in common. You are gold, fat, and rich, and I'm 2/3 of the way there myself.
Well, I wish we could shed the old.
I'm gonna stay out of this conversation. I plead the fifth, Your Honor. Cool. Well, when I look back at what's happened over the past, let's just say, few years, one of the big one of the big anticipations when President Trump was initially elected, there was a huge amount of speculation that he was just going to destroy America, destroy this, and gold, for a moment, was the place to go. Of course, we saw that the equity indexes has soared ever since, and gold hasn't done as great. But now we're starting to see, with the international conflict and more instability, geopolitical instability, this nice rally in gold. How much do you attribute this current move to the political environment, or is it just simply supply and demand factors?
My experience in the last 45 years has been that politics and geopolitics has only very near-term impacts on the gold price. The thing that really impacts the gold price is faith or lack of faith in the purchasing power of the U.S. dollar, and in particular, the U.S. dollar as expressed by the U.S. 10-year Treasury, which is, of course, the world's benchmark security. There was a point in time 7 or 8 years ago when people looked at a 6.5% or 7% yield on the 10-year Treasury and thought, if I buy $1 million worth of gold, it's costing me $60,000 or $70,000 a year in foregone income to own it. And people were less concerned about the balance sheet and the income statement of the U.S. government. Today, with the 10-year Treasury yielding what, 1.87?
Yeah, 1.87. Yeah,
something like that. The avoided cost, particularly relative to the CPI stated rate of inflation of 1.6, means that the federal government is paying you 27 basis points to store your money for 7 years, or 10 years, pardon me. Jim Grant went so far as to call that return-free risk, which is not a very attractive proposition. The second thing that I think is really impacting the gold price has been the realization, not by cranky old gold bugs like me, but rather by the Ray Dalios and the Stanley Druckenmeyers, that the balance sheet and the income statement behind the U.S. government is not good.
Right.
It hasn't been good under Democrats, and it's not good under Republicans. The truth is that we have, at the federal level, not state and local level, $22 trillion in on-balance sheet liabilities, about $17 trillion net of the balance sheet assets at the Fed. And off-balance sheet liabilities, according to the Congressional Budget Office, are about $100 trillion. That's things like Medicare, Medicaid, well, things like me. So we have recourse obligations to each other of $120 trillion, which is a lot of money.
Yeah, drop in the bucket these days.
And we propose to extinguish that and service it out of the national income, which is, of course, taxes and fees less expenses. The problem is that number this year is going to be negative to the tune of about $1.5 billion. And people like Ray Dalio are asking the question, how do you add a column of negative numbers and come up with a positive sum?
Special accounting.
Well, the answer right now seems to be modern monetary theory, which, if you and I did it, would be called counterfeiting.
Yep.
And the realization that the thing that fills in the budget gap is phony really, I think, drives gold much more than people's perceived fear of Trump or their perceived fear of Bernie Sanders or even their fear of hot conflict with Iran.
Yeah, I'm with you. I think it is short-lived. I think it's just the mere uncertainty of what's going on, I think, has been a big catalyst for it. I'm bullish on gold right now. I caution people every now and again to not get so excited that you end up buying all-time highs. It's about timing and making sure that the price is right for you to buy into any of these precious metals. Here's a different question for you. I'm not sure if this is an area of your purvey, but we have a fan of yours from Canada, Brendan, one of our regulars on the show. He says, what's your outlook for uranium for 2020?
For 2020, really, really, really muted. I've been saying for some time that an increase in uranium in the near term requires a more aggressive program of restarting Japanese reactors that were shut down as a consequence of Fukushima. And although there's widespread support for that among the political and business class in Japan, there is a lot of popular opposition to it from people who believe, I think correctly, that they were misled with regards to the safety of some of the Japanese nuclear plants. So in the sort of, and I've been saying this for some time, in the 12 to 18 month time frame, the uranium price is really, I think, a function of Japanese restarts. Looking out, I don't know, 2 years, 3 years, 4 years, the truth is that we're using more nuclear fuel now than we have at any other time in history. And the increased utilization of nuclear fuel is being driven primarily in the Far East, primarily in China. And so new build construction eventually, when I say eventually, 2, 3, 4, 5, I don't know how many years, takes care of the problem. But in the near term, it's really a function of Japanese restarts. Let me share a little arithmetic with you about uranium, though, that I find very interesting. The International Energy Agency suggests that the fully loaded cost to produce a pound of uranium worldwide, and when I say fully loaded, I include the cost of capital to the companies, and I also add back their prior year write-downs. In other words, I also make them account for their own stupidity. And that number is somewhere between $55 and $60 a pound. So it costs the industry, let's round it off and make it 60. It costs the industry $60 a pound to make the stuff, and right now they're selling it in the spot market for $27. In other words, they're losing between $25 and $30 a pound, and they're doing that 100 million times a year. That's pretty
math.
boring.
Yeah.
Yeah. Now, while on the face of it, one would say, why on earth would you buy uranium stocks in that case? Well, the reason is that even in the United States, which is rich enough to afford other forms of fuel, about 16% of American baseload power is provided by nuclear power. And if the industry can't earn its cost of capital, in fact, if they lose $25 a pound or $2.5 billion a year worldwide, 5 years from now or 6 years from now, the lights won't go on. And that just ain't going to happen.
Right.
If you think as an American that 5 or 6 years from now, when you walk into your house and hit the switch, the lights are going to go on, then you believe that the price of uranium is going to go up to the cost of production. Or else you believe that Trump and Newsom and all those guys are going to cover the whole state of Nevada with solar cells or something like that. I mean, there's sort of inescapable upside.
Right.
And I like circumstances where the answer to the question begins with when. In other words, when will this happen? It isn't an if question, it's a when question. But many speculators don't have very much of a sense of humor for when questions.
Right. Yeah, we actually brought up the uranium chart here, which one I haven't really looked at. But at this point, when you look at this chart, this is a monthly going all the way back into 2008. You can see, obviously, if you're a trend trader at all, you'd want to stay out of this thing from a long perspective. But we really, for the better part of a year, just traverse sideways between 26 and 24, let's call it 23 and a half. Not much of a range out there. So, for those that are looking at this, you kind of want to let it make its move before you jump into it. It's just sitting here doing nothing right now, which to me would be a waste of time and capital, where you could be allocating those resources or that capital into other maybe precious metals or different commodities which may offer you a greater rate of return. While there may be some great potential, it just doesn't seem to be exhibiting it right now.
My friend Steve Sugarroot says that you buy products that are cheap, unloved, but in an uptrend.
Yeah, right.
I think
the
uranium gets
friend.
1 and 2, but doesn't get any part of 3 yet.
Right.
The one thing that I would suggest to you is that when you do see a move in uranium, the upside move in uranium stocks is so extraordinary that being early becomes a bit less of a sin. One thinks in terms of time value of money.
Right.
That being 3 or 4 years early is analogous to being wrong. In truth, when the asset class, that is uranium stocks, goes up 1,000%, you can employ a pretty serious discount rate. And when uranium stocks do begin to go up, there are enough speculators with enough money who remember the last bull market in uranium stocks, which was the most extraordinary financial event that I ever witnessed. And we remember it with some fondness.
You sure?
So, I would say, for sure, keep an eye on that. And don't play the game probably by buying uranium. Play the game by understanding which uranium stocks you want to participate in, because when they go, they move like no other asset class I've ever seen.
Do you have a favorite?
I really don't, and it really depends on the investor, frankly.
Okay.
The institutional favorite, the easiest one for people to get their heads wrapped around, is Cameco, because it's Canadian.
Right.
It's the largest and lowest cost North American producer. The truth is that the largest producer and the lowest cost producer is Kazatomprom. But to buy that, you have to have a sense of humor for a Kazakh/Russian stock.
Yeah.
I, in fact, own it. But I have more of a sense of humor for that kind of thing than other people do. People who are more speculative, and I happen to be one of those, should look to the uranium juniors. My suspicion is that virtually all of the uranium juniors will have to raise more equity to get through this bear market. And my own inclination is to buy those uranium juniors during those financings, during those private placement financings, and try and get them to give me a warrant in return for my money.
Right.
In other words, sort of doubling my upside.
Right. A little bit of, hey, you're taking some big risk. We'll reward you down the road.
Rick,
Yep.
Rick, I'm going to give you, to close the show out, I'm going to give you a task to help Dr. Walter Block, a good friend of both of ours. I'd like you to tell our audience in Cliff Note version why you're not a Keynesian and why part of your success is that you've always leaned in the favor of Austrian economics since you got into this business.
In my first year in university, I took the same sort of first-year economics class that anybody else does, and I didn't know a damn thing about economics, but I knew that what they were talking about in the Samuelson book, which is basically Keynesian, even as an 18-year-old, I was thinking, these guys are crazy. This isn't how the world works. So I didn't want to have anything to do with economics for a fairly substantial period of time until I read a book, Economics in One Lesson by Henry Hazlitt.
Yep.
Turns out that I was a confirmed Austrian. It's just that I was so naive that I thought that was a place in Europe or something. I didn't realize it was a philosophy.
You thought that's where they invented strudel.
That's right. And further to that, I've read. I'm a voracious reader. I've read a lot of books, in particular investment books in my life. And the truth is that Human Action by von Mises, if you don't think of it as much as a book about philosophy, as a book about its title, Human Action and Volition, really is the basis of my success in business, understanding what motivates people, how people invest, why people invest, how political constraints on free actions operate. I would say for me, Human Action has been the most important book I've ever read. Certainly, once I began to understand the common sense behind economics, it was pretty easy for me to gravitate to people like Walter, who, as you know, I'm very fond of.
As are we.
As are we.
Rick, I want to thank you so much. How would you recommend our viewers stay in touch with your organization?
Well, I'm going to give them an incentive to stay in touch with our organization.
Nice.
See, I'm reading Human Action still. If any of your readers care about my opinion about natural resource investing, I would invite them to send me by email a copy of their natural resource portfolio. Please put the names and symbols in the text, not as attachments that our security people won't allow me to open, and email it to me at rankings, RANKINGS, at SprottGlobal.com. I will rank every company in your portfolio that I'm familiar with.
Wow.
On a 1 to 10 basis, 1 being best, 10 being worst, and comment on those companies where I think my comments might have value, and return them on a no obligations basis.
Very nice.
You're like Santa Claus right now to a couple of my viewers who are mad about metals in a good way. They love it. I'm sure you basically just made their entire year.
I enjoy doing it. I learn a lot about how people think and how people invest from grading those portfolios. It's been useful to me too.
There's also a lot of resources for you guys. They have a thing called Insights, which you can see at SprottUSA.com. There's some nice articles there about different precious metals or just natural resources as well. So there's a lot of great resources for you to check out as well.
We have about 200 hours of educational material on the Sprott websites. Those websites include Sprott.com, SprottGlobal.com, Sprott Insights, and Sprott US Media. All told, there's about 200 hours of free educational material on the sites.
Awesome. Well, Rick,
thank you, Rick. Have a good year.
Yeah, that was awesome. Thank you so much.
Pleasure. Thank you, gentlemen. I look forward to visiting again.
We will.
We should get him in studio here, Johnny. He's right down the street, isn't he?
Well, he's in Carlsbad, or near Carlsbad, and I don't think that would be too difficult for us to do. We could probably figure that out, Merlin.
All right, sounds good to me, guys. I hope you enjoyed that. We actually went a little bit long on that one. We didn't even take a commercial break. You gotta love that one. That was just one giant show out there, and I know we've got a bunch of viewers. So Brendan, you already gave us some feedback. Cool, good. Glad you were listening. I knew you were there at some point. Let's do this. If you guys, again, if you want to know more information, I didn't get the whole email thing you sent out. You can go back and rewind the video there to check it out. Also, check out the resources. They have some great articles and information about the precious metal space. I know we have a lot of people who are fans, and I am a precious metal fan. I know John O'Donnell is as well. If you are a little interested a little bit more maybe in the active trading and management of it, long-term portfolio pieces, I would encourage you to check out our educational content, which is going to be at tradingacademy.com, or you can simply click that link that's going to be showing up in your social media right now. If you're on YouTube, Online Trading Academy, or Power Trading Radio's YouTube channel, you'll see that show up there in the chat. Just simply click on it, type in your zip code to tell you which of our 50 physical brick and mortar schools are nearest you. There's also a link at powertradingradio.com that you can click to find out the same info. I'm going to go right through, John, since we are late today, and
Sounds
through. It's a weekend. Are you doing anything? You going anywhere? Teaching?
Nope.
No, he's not teaching. So
I'm going to be doing some seminars in our classes next week here at our Irvine office, but I haven't got anything this weekend.
Niners or Vikings? What are you thinking?
I am picking the Vikings to go to the Super Bowl.
So just so everybody knows, John O'Donnell will not be on the show next week. He will no longer be a guest on Power Trading Radio.
As a matter of fact, I mean, I know that if I can get some points, I'm going to take the Vikings to win the Super Bowl.
Really?
Yes, I am. I think
you and Larry should love it. Larry's a huge Vikings fan. I think it's going to be one heck of a game. The Vikings really did a number on the Saints, so it's going to be a good one.
Skol, Larry.
Skol. All right, TJ, bring up your economic calendar. Let's show the folks what's happening on Monday, January 6th. Not too much. You've got ISM non-manufacturing PMI numbers. What for the 6th? Why do we talk about the 6th here? We're on the wrong one, TJ. You know what? We got the wrong one, and I don't have the new one up and ready. So I guess we're not going to show them. your economic announcements for Monday. So you'll have to wait and see for our Monday show to find out exactly what's going on out there. Sorry, I thought it was all set and ready for everybody to just just wow you with all that information. But maybe TJ, if he's quick, which I know he is, he'll bring it up here in just a second. So we had the wrong day for you because it's the 13th on Monday, not the 6th. As much as I would like to go back into time, John.
Excuse me. Why are we blaming this on TJ?
Because it's always TJ's fault. That's what happens
I
with
see.
TJ. There you go. Thank you, TJ. See, he's on it. He brought it back up. Look, he's got skills. That's what TJ does. There we go. I thought Monday was kind of a quiet one, and our manufacturing data came out last week. So here's the 13th. Nothing for the U.S. We also have for GDP for the British pound, manufacturing productions, and goods trade balance for Canada. The Bank of Canada Business Outlook Survey, and New Zealand with the NZIER business confidence numbers. Now, Monday's earnings calendar is a little bit boring. It really all kicks off on Tuesday, but Monday nonetheless. We have Shaw Communications, Washington Federal, Limoniera, and Oramed Pharmaceuticals. Guest for the show on Monday will be Sean Reed, one of my favorites from Online Trading Academy, longtime friend of mine. He just, again, he moved away from Southern California. I was heartbroken when he left, but great guy. We'll talk about futures markets and financial markets. So that will be our guest on the show at 3 p.m. Pacific on Monday. Hope you guys enjoyed today's show with Rick Rule. If you'd like to know more, go to SprottGlobal.com. Find out more information or click our links to find out more information on how Online Trading Academy can help educate you on these financial markets. Until then, happy trading, everybody.
Peace.
We're out of here.